Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The USDA WASDE report was received bearishly, and in doing so sent the market down to support. Corn first tested our 342 half number as would be anticipated and bounced off of that number for a couple of days, but since has come back down and broke below that level, touching 338 to 337. As evidenced on the chart, we can see we had potential support coming in near that 337 number. Today the market's giving us a small bounce, but a continued decline would not surprise us. We do believe that somewhere in the neighborhood of 337 to 340 could very well become good support for this market after having been sideways for quite some time in the breakout to the downside. Upon reaching support, then the market could find its way back up, but for now this 338 to 337 number should be a key level to watch. Something of note for this particular contract is the way that it responded to the 360-degree mark. After breaking below 344 half, you'll notice the way in which it responded to that level after having gone through it. Upon making a clean break of that number, the market came back up and actually gave us a lower high below that number and came back down. This suggests to us that if the market breaks this 45-degree mark prior to making it back above the 360-degree mark, that continued weakness could very well be persistent. If the market is in fact able to get back above the 344 half number prior to breaking 335, then a significant low could very well be in place. We could potentially start to see the market make a significant corrective move to the upside. We've mentioned before the importance of the next time factor that comes in very close to the Thanksgiving timeline, and so we'll be looking to see the way in which the market responds early to mid next week. The March contract is giving us a very similar formation where it broke the 357 quarter number. Upon doing so, the market gave us that very same formation where it gave us a lower high just below support and continued lower. It's also tagging up against our 1-by-1 angle, and this is where the market is potentially finding a bit of support. And so the market's ability to start moving up from here is possible, but again, we're looking at sometime early to mid next week as a potential turning point for this market as we approach the Thanksgiving holiday. The level of significance that we are monitoring for the March contract would be the 360-degree mark that lives at 347 half. If the market's able to stay above this number, then we can potentially see a low that comes in. Breaking below this 347 half number would be an indication of potential downside weakness. Our market cycles that had been pointing towards a decline in beans through the middle of November had yet to really come to fruition. Although last week, over the last 4 to 5 days, we've noticed that the market finally did make a bit of a decline. Regardless of the price action, we've been looking to about the 15th or 16th as a potential timeline where the market would make a reversal, regardless of the direction in which it moved into that timeline. Through yesterday, the market had been moving down into the 15th, which is today, and we find soybean making a small bounce. Despite the bounce that we're seeing right now, we think that overhead resistance is still very probable, given the bearish nature of the WASDE report that was recently released. And over the next couple of days, even if this market's able to edge its way up a bit, we do anticipate that at least one more significant leg to the downside is in the cards for soybean. The harvest is very close to being completed as far as the data is concerned. And so once this harvest is in fact complete and we start to transition our focus over to South America, we could then begin to see a potential low setting in, from which point this market can then turn up. For now, short term, we do anticipate continued weakness. The decline yesterday was just shy of reaching our volatility bands near 960, and from there you can see the market is moving up reasonably well. We do think that the market still has the potential of coming down to test somewhere in the neighborhood of about 940 before placing its final low. That too does remain to be seen. And one more time factor that we want to bring to your attention again is that November 20th timeline. Given that the market's moving up from here, we would not be surprised to see this market maybe move up slightly up into the 20th. At the 20th, look to make a significant high, and then from there turn back down again. Wheat futures continues to move as anticipated. Now we moved down to support near the 415 number. After bouncing off of there, the market then made its way back up to resistance at 435. Upon finding resistance, the market continues to find its way back down, and we would not be surprised to see a break of this 415 number. We continue to have a downside potential target for wheat coming in at about 400 to 405. Upon reaching that area, we do think a significant low would be in place. So whether or not this market actually moves down to the 400 number remains to be seen, but what is of particular importance is how it responds to the upcoming timelines that we're looking at. We do have a timeline coming in very close to the Thanksgiving holiday, followed by the next timeline of November 30th. It stands to reason that one of these two dates could end up being a timeline for a significant low for this contract, at which point we would roll over to the March for follow-through. It comes as no surprise that the March contract is trading in a similar fashion, having made a low at 434, then made its way up to resistance, and now we can see the market is making its way back down again. It also bears mentioning that this move that we see here has actually been fairly sideways after having reached resistance. So breaking back below 434 suggests that a price target below of 424 is possible, and upon making it to 424, we think that this is a very good spot for a significant low for this contract. Most of the price action that we have seen has been churning inside of volatility-based support, and so once this market is able to break away of either side of this volatility band, would give us the idea that the market looks to have continued strength in that direction. Again, downside potential target sits at 424, and if the market's able to break above this 445 number, we're looking at a minimum price objective overhead of 466. As far as December crude is concerned, we had previously shared that the market had established a 5-wave Elliott sequence where we had our first leg up, followed by wave 2, then we had our wave 3, wave 4, with the potential final leg 5 finding resistance at a 270-degree mark near 58.5. We suggested if the market was able to get above this 58.5 number, that continued strength was probable, but in the event that it fails here, that potential support could live near the 54.80 number. The market has since come back down. As you can see, we're finding a bit of support here, but if the market breaks below this level, we do have a couple other levels of potential support that could come in near the 52.80 mark and potentially as low as 51.03. In doing so, we're looking for the market to hold the 52.80 number and then bounce from there. If it cannot hold this number here, then continued weakness is what we would anticipate going forward. There has been some news coming from Saudi Arabia suggesting that the market can have some legs, but the pattern itself tells us that the market has run its course in the short term and that it's due for a correction at the very least. Traders will inevitably begin rolling over from this contract to the next major contract. With that being the case, we will analyze the forward contracts in our subsequent updates. We'll close out with the US dollar index, and as we can see here, in its first approach up to the $95 mark, this level appeared to have been insurmountable for the dollar to get beyond. We now see a very strong correction that has moved down to 93.40, and the market has since bounced off of this number, but you can see almost to the exact cent that very good support came in at this 93.42 number. From here, the dollar, after having touched it, has moved back up, and so we could see a corrective move to the upside. It is sitting very close now to the 180-degree mark at 93.90, and so the market would need to get back above this number, and in closing above this number or staying above this number for the balance of the week suggests that it could make one more run to the 95 mark or higher. If the market closes below this 180-degree mark, we anticipate that a move down to about 91.95 at a minimum is quite possible, testing the 360-degree level for the US dollar. Moving on to the weekly chart, we can see from here that if this market has put in our wave 2 or B pivot of this leg, that breaking below the $91 mark that we spoke of suggests that the market could very well continue lower, and we could find ourselves in a situation where the dollar looks to make its way down to our projected C or 3 leg as annotated on the chart here. So what we see this week is going to be very important for the dollar, or so it seems, and over the next couple of weeks, the way in which it develops should give us more confirmation as to whether or not continued weakness is probable. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.